Hello my fellow investors and welcome back to another stock analysis video. Today guys, we are going to be analyzing the second company that Lionel S asked for, and that is Univar Solutions. Now guys, we're going to analyze this company based on their fundamentals and see if at the current share price it is a buy. So with that said, let's get started with this analysis. Now guys, before we actually head on to any numbers at all, I actually want to show you guys exactly what this company does, because I didn't even know what this company did when I first saw it, and it's actually pretty interesting. They distributes commodity and specialty chemical products and provides related services worldwide. Basically guys, they distribute chemical products like acid and oxides, etc. So it's actually fairly interesting because, well, I don't think this kind of company will ever essentially go away, since, well, a lot of companies need these kinds of products delivered to them, right? So now let's come over here guys into the calculator. We got the ticker symbol for UNVR, market cap of $4 billion with a current PE of 6.9. Now this PE of 6.9 with a current share price of $23.55 might be actually a pretty decent price, seeing that on the 1 year they are down 6.18% and on the year to date they're down 16.13%. Now they aren't at the 52-week low, but they're fairly close to that, as you guys can clearly see here. Now they do not pay out a dividend, which means that essentially all of their cash flow is going straight into themselves to pay down debt and to buy back shares. Let's take a look at some of these fundamentals, starting of course with the net income. We got 5 years ago of $120 million to 1 year ago of $460.6 million, increase of 284% on the 5 year. Now unfortunately guys, we do have a couple of outliers here in the form of 3 years ago and 2 years ago. 3 years ago guys, this was before COVID, they came down to negative $100.2 million. Then during COVID, they came up a little bit to 52.9, and then ever since they did a massive jump from 2 years ago to 1 year ago. Now this jump, it was pent up demand, but what really concerns me here is this 3 year ago value of negative $100.2 million. So definitely something to do more research on for this. But overall guys, I can't give this higher than like a 30% because, well, essentially this 3 year ago value at a negative is very concerning. Coming now into the free cash flow, here we actually get kind of a different story. We got 5 years ago of $200 million to 1 year ago of $179.4 million. That is a decrease of 10% with an average of $186.32 million. Now in the last one guys, we saw that the 3 year ago value was in the negatives. However, this one, the 3 year ago, was actually the highest at $241.4 million. The drop that we saw here 2 years ago guys, related to COVID, that's perfectly fine, and as you can clearly see, as of 1 year ago, they are at least coming back. So for that reason guys, because this is somewhat explainable, I'm not going to necessarily hit this company when it comes to a grade because of this 2 year ago value, but mainly for this 5 year ago to 4 year ago value where they came down at around $5 million or so. So for that reason guys, and on top of the fact that it is not consistently increasing, in fact they're decreasing on the 5 year overall, I'm going to give this like a 40%. Now coming into the revenue, this one is by far the best one that I can see so far. 5 years ago of $8.3 billion to 1 year ago of $9.5 billion, increase of a little bit more than 15.5%. We see a dip here 2 years ago, COVID related, that's perfectly fine. But aside from that guys, they are still beating their even highest point past before COVID of $9.28 billion 1 year ago, which was $9.5 billion. So for that reason guys, I'm actually going to give this a 100% because, well, they are consistently increasing, and I'm essentially going to ignore this COVID related value. Coming now into the total assets minus the total liabilities, let's see if the company is able to survive an economic downturn. Obviously doing this, you want the assets to be higher than the liabilities, and currently guys, they're at $2.6 billion in this difference. And on top of that, within the past 5 years, they have increased this pretty consistently upwards, which is really good to see. Average total assets, it's around $6.3 billion. Average liabilities is around $4.5 billion, and doing this difference we get $1.8 billion. I'm not going to give this guys a perfect score because you can see right here there wasn't really much of an increase from 3 to 2 years ago, but it's still very solid overall. So for that reason, I'm going to give it like a 95%. Looking now into the cash flow minus liabilities, similar to that of the assets minus liabilities, but remember, cash flow is what companies use to pay down their debts. So if we do this exact same math guys, this tells us if the cash flow is able to subsidize their liabilities. Now, as it currently stands, they're at negative $4.3 billion. However, as you can see, there have been some instances, even recently, where this value has actually gotten closer and closer to zero, meaning the negative is getting smaller and smaller and smaller. And for that reason, guys, we see here 3 to 1 year ago, it's actually decreasing, and it decreased once again from 5 to 4 years ago, a massive amount. Average cash flow minus the average liabilities, we get negative $4.3 billion. I'm going to give this, guys, like a 90%. It is really, really solid. Now, coming into the most underrated metric of all of them, the shares outstanding. Normally, guys, people skip this one. However, in this channel, we look at this one because this one essentially tells us if the company is using that cash flow to grow the ownership of the investors. Essentially, when you buy a share of company, remember, you are part owner. If a company issues shares, you're being diluted as an investor. If they buy back shares, they are giving you a larger share by default. Now, companies that don't pay out a dividend tend to issue a lot of shares, and unfortunately, this one is the case for that one. 5 years ago of 141.1 million shares to today of 167.1 million shares, increase of 18.43% from the 5 year, and from the previous year to the current year, that is a decrease of 1.36%. So they did a massive jump, guys, from 4 years ago to 3 years ago, and even from 3 years ago to 2 years ago, they increased it, and they did another increase, guys, from 2 years ago to 1 year ago, but they have been buying back ever since 1 year ago. But overall, guys, it's increasing shares. They've actually been increasing shares more than they've been decreasing. So for that reason, I have to give this like a 20%. Coming now to the cash and equivalents, they currently have $234.8 million with an average of almost $300 million. Taking a look at the overall view of all of their fundamentals, net income 30%, free cash flow 40%, revenue 100%. Revenue was really solid. Assets minus liabilities 95%, cash flow minus liabilities 90%, and shares outstanding of 20% for an overall grade, guys, of 58%. The biggest concern here is this net income as well as the shares outstanding and even their free cash flow. If they can at least fix the net income and the free cash flow, the shares outstanding, I can kind of understand them issuing a few if they think that their current share price is overpriced. But as it currently stands, guys, 58%, it's not cutting it for me as it stands. Now let us make some assumptions using, of course, revenue growth, projected share buyback, and the required rate of return. Coming over here, guys, to Seeking Alpha's growth tab, we can see that the forward is actually 8.88% and the year over year is 26.66%. Now, I'm actually going to be a little bit liberal when it comes to this because I don't foresee companies not wanting these kinds of products being distributed, right? Companies will always need asset, will always need phosphates, will always need these kinds of things. And companies like these that distribute it are kind of insulated from this effects. It's similar to like how midstream companies are less affected by oil markets because they're mainly in the business to distribute the oil, right? To bring it from the upstream down to the downstream. So I think that kind of is similar to this. So for that reason, I'm going to give the low assumption of revenue growth of 9%. For the median, let's go with 12%. And for the high one, let's go with 15%. Now for the projected share buyback, guys, they have been issuing shares at a massive amount. And I have to continue this trend. So for that reason, for the low assumption, let's say that they'll issue shares at negative 15%. The negative just means that they're issuing. For the median, let's bring this down to like negative 12%. And for the high one, let's bring this to negative 9%. And with that, guys, we get some target share prices, not adjusting for debt, of $9.60, $10.92, and $12.39. Now, unfortunately, adjusting for debt for the low and median assumption, unfortunately, you can clearly see here that they're in the negatives, and that's because of the fact that, well, basically, the amount of net debt that they have exceeds the amount of cash and equivalents that they have, and also exceeds the market cap that the calculator comes up with. That's why this is in the negatives. However, if we take a look at the high assumption, it's not in the negative, and it is at 20 cents, guys, adjusting for debt, and with the highest margin of safety of 15%, this becomes a 17-cent company. Now, most of you guys are looking at this and you're like, 17 cents, $12.39. The company has a PE of 6.9. How could this fall to, $12.39? This is clearly wrong. Understand, guys, the way the discounted free cash flow works, it is not telling you the stock price of the company. It is telling you the intrinsic value of the company based on projected free cash flows, revenues, and net incomes. That's why you're getting a $12.39 share price. Obviously, if you guys do not believe this, that's perfectly fine. You guys can make your own assumptions when it comes to this. That's why I have this calculator available for free, as well as my other two one, the book value one, the REIT one, and even a dividend tracking sheet. Now that I actually mentioned that, let's actually come over here to the book value calculator and see the book value per share to get a second opinion. Now this, guys, takes into account 0 assumptions on my end, and this one basically tells you how much their company should be worth based on the assets that they have on hand divided by the shares outstanding. And currently, guys, they should be valued at $15.43. So book value is telling me that it should be worth at $15.43, and my discounted free cash flow is telling me that at the highest point it should be worth $12.39. Essentially, guys, I'm kind of in the correct ballpark if you think about it, seeing that you have this one as well as the book value kind of telling me that it should be worth at around this kind of share price. Now obviously, if you guys do not believe my assumptions, that's perfectly fine. Again, have these calculators, make your own assumptions. This is not financial advice. For example, let's say that you believe for the high assumption that they'll do 25% revenue growth and that they'll buy back shares at a massive rate of like 5% in the future. Guys, now this becomes $19.40, not adjusting for debt. As you can clearly see, everything is just dependent on what you believe the company will do in the future. Very, very subjective. That's why, again, have these calculators, make your own assumption. All I'm asking for in return, guys, for free content, free calculators, is just help me grow my channel, like, subscribe, comment. I will never plan on taking sponsorships as well as affiliate links. If maybe I do, it'll be for like something food related or water related. Aside from that, guys, don't really want to do that. The best way to support me and in my endeavors is just like, subscribe, comment, help me grow my channel, and just tell your friends, tell your family, you know, the market has been going down. Now it's a good time to invest. If you're scared, you shouldn't be. This is a great time to invest overall, because even though money is made in bull markets, millionaires and billionaires are made in the bear market. Great time to buy, in my personal opinion. So this is basically what I teach on my channel, how to evaluate companies and figure out a good target share price to buy them at. And then once it reaches that, you might consider buying it. So again, thank you all so much for everybody who have subscribed so far. We're almost up to 1,200 subscribers. I really do appreciate it. Thank you all so much. All in all, when it comes to Univar, I kind of like this industry, honestly. Things that distribute, kind of like how I said, midstream oil companies that essentially transport oil from like upstream to downstream. Kind of like how this one, they don't necessarily manufacture the products, but they distribute it. I think they are a little bit more insulated than the ones that actually make it or that sell it, but clearly their fundamentals, guys, still need a little bit of work, especially in that cash flow, net income, as well as those shares outstanding. They need to fix it. But aside from that, once they fix it, I don't foresee this company to be a bad company overall. Really, really solid business model. That pretty much does it for this video. Like if you like, comment, subscribe. It really does help her with the algorithm on YouTube. You guys can follow me and my new tech sites, a link in the description below. So with that said, peace out, and I will see you all in the next stock analysis video.